Good morning, everybody. Happy Friday, and welcome to another edition of Fast Market. I'm Kevin Hinks, joined, as it seems like always, we're going to get this guy in office, by Scott Bauer, CEO of Prosper Trading Academy, and live, stranded by the snow in Omaha, Nebraska, our own contributor, Sean Cruz. Cruiser, stranded in Nebraska. How you doing?
It happens. I'm just going to make the best of it, do a Nebraska Cornhusker tailgate tomorrow. I'll make a weekend out of it.
There you go. Just stay away. Just be careful when Pat Smith's involved, all right? Just be careful.
That's exactly what I'm going tailgating with. So exactly. Right.
Oh, that's not good news. All right, let's get to the markets here. So, you ask me what summed up the first couple hours of trading here? Scott Bauer, Apple to the rescue. Apple's market looked ominous when the day started.
Absolutely, and something I've been talking to my people this morning about has been a little bit now of the separation of some of these stocks, right? You've got NVIDIA that just absolutely is
right. Got its own problems.
Has its own problems, but yet it's not systemic, at least not today. In the past, over the last few weeks, months, we've seen an entire sector actually move in concert with one another. Today, though, you're seeing, Apple has a nice little rally right now. It was down pre-market. It's up a couple bucks right now. Amazon well off its lows, though trending a little bit lower right now. So, Apple to the rescue, like you said, and we'll see how this holds up throughout the rest of the day.
Here's the question that has a lot of zeros on it, Sean Cruz. Are these sell-offs, is this correction that we're in right now starting to lose some of its teeth? Because yesterday's comeback was outstanding. This one, tried to give it a punch this morning, no dice.
Yeah, I think this is for me, looking at the VIX is what I'm trying to gauge, just how much teeth any sell-off or rally has. I'm going to look at the VIX and see what the VIX is doing. The VIX still hovering around 20. So if we had this kind of a pullback, especially in that tech space, and you get that alongside maybe a massive spike in VIX up to 25, I'd be a little bit more concerned. But this just seems like just what I would call just routine volatility for the market lately, just this back and forth chop, really no major movement either way in the VIX. So I think this is just kind of what has become business as usual for the markets in this volatile time.
That's right, you guys. You have the NASDAQ obviously down about 0.6%. Besides that, no real damage being done to this market. I mean, just slight, a little bit in the Russell. Besides that, though, S&P strong. Dow futures up 33. So this market is taking a punch here and hanging in here. Here's why I want to say it, because there's a lot of concern. You read the articles, the headlines, a lot of concern in these markets, but it looks like some of the bangs that these stocks are trying to do on this market are running out of gas, Scott.
Totally agree with that. And this market is completely being driven by risk headline at this point. And there's so much of it out there. You can't discount it, because I've never seen, Kevin, we've been in this business a very long time. I can't remember a time where you've had so many different things on the headlines. Now, that being said, I agree with both Sean, I agree with you. I think a little bit of pressure has been taken off the downside here, because otherwise we would see the VIX spiking up mid-high 20s.
It's a good call on the VIX, Sean, because believe me, that's the fear index, right? If this market is basically, with all the news it had last night in NVIDIA and Nordstrom, if this VIX is down, that's basically telling us that people are not as concerned as we thought they might be. Believe me, overnight, they didn't look so good. They were all down, and all of a sudden, a couple of the indices just lost their momentum on the downside and recovered. And then Apple opened up lower and got a bid quickly, Sean.
Yeah, and I think this is going to make sense going both ways, where you're going to expect to get these moves, but I think on the upside, you're going to see buyers get exhausted a little bit after, it would say a 0.5% or 1% move. And then on the downside, what you're seeing today is just sellers got exhausted. We ran out of sellers in the market, and that allowed the market to find a little bit of, I'd say, a consolidation level. And I think this is going to be interesting to see how we play off of this going into the remainder of the trading day today and how we close. Because I'm looking at this a lot, and right now when Scott's talking about the headline risk that's out there, those headlines can come out throughout the weekends when the markets are closed. So I never really expect too much of a rally or too much buying going into a weekend, just because no one's going to want to hold that risk through the weekend. They're just going to hold off, wait to see what comes out, and then Monday make a decision if they're going to come in and start buying again.
I completely agree with the last hour of the day. You hear me say that a lot on these shows, how important it's going to be. But here's my thing. Where's the bigger risk? Is the bigger risk to the downside here or the upside? Let's say something happens with Brexit, something happens with China. Where's the bigger risk for this market in terms of a big move?
On a snap move,
yeah.
I think the bigger risk is actually to the upside because there is so much negativity already priced in. Now, if we do get something, let's say out of Brexit, where they say a deal is absolutely not going to happen, that's some downside risk. But I think the bigger risk is that we do get some sort of positive news, whether it's Brexit, whether it's tariff talk, whether it's the Fed, whether it's the Fed speaker that's coming out today or Jerome Powell that says, okay, maybe we're going to reevaluate a little bit. That's the snapback risk that I see to the upside in this market.
Guys, I believe that each earnings season takes on a personality. Right? And let's think about the week that we've had, Sean, in terms of earnings. Rob's got the chart for me that I want to put up here. Walmart, Home Depot, Macy's. 3 stocks, all with beat analyst estimates, all with necessarily good earnings, all down after their earnings move. Why is this earnings season taking on that kind of a personality, Sean? Your thoughts on that?
So I think it's all about outlook. And when you think about stock markets, you think about equities, they're just massive discounting mechanisms for whatever future expectations are. And I think right now there's a lot of concerns that are going to weigh on some of these stocks. So if you're looking at these consumer-related stocks, we're going into this season. If you look at producer prices, which measures input costs in these industries, we've seen massive buildups in transportation and warehousing services, which is a direct expense for these companies. So you're going into what is their biggest revenue-generating time of the year, and they're going to be bringing in these revenues in the midst of increasing costs, not only from the labor side, where you're getting tighter labor markets, you have Amazon going in, increasing wages, so you have wages pressures going in there, and then you also have just cost of doing business pressures from transporting a lot of these goods around. So I think right now markets are genuinely concerned about margins for these companies. And if that was just in and of itself in a vacuum happening, that'd be one thing, but you're doing this against a more general, broad backdrop of expectations for lower growth around the globe. So you really have some serious headwinds that I think investors maybe aren't completely bearish on this sector just yet, but they're certainly having a little bit more of a wait and see approach, and I think that's why you're not getting a lot of buyers coming in just yet.
Scott Bauer, from a trading perspective, this affects your psyche when getting ready for these earnings moves, right? You're like, good is bad, really good is not great, so bad is horrible. So how does that affect the people that you talk to in your trading rooms? How does that affect them? It wears on people after a while.
No question about it. And the emotional side of trading is so prevalent right now. Mm-hmm. The bearishness that's out there right now is so prevalent. So we have to tell people, I have to tell people, take a step back here, right? Take your emotion out of it. Take what you feel right now, because everybody's got some angst, and everybody is just this cloud. Take that out of there and look at these individual equities, individual stocks, one by one. Now, Sean, to your point, one thing that really sticks out to me that we typically don't see, but we are seeing right now because of this cloud, Walmart, Home Depot, Macy's, yeah, the reports were, medium, so, but they all came out and their guidance, their expectation was actually positive.
Yes.
But yet, we're seeing all these stocks get hit. Why is that? That's because of this emotional, psychological overhang of a cloud in the markets right now.
Sean Cruz, Home Depot got downgraded today. Off their numbers that they put up, downgraded today, stock down another 0.7%.
Yeah, but I think when looking at Home Depot, we've seen this discussion. It's kind of been lingering out there, and that's the Home Depot versus Lowe's discussion. Yep. And the relative outperformance of Home Depot to Lowe's. So I think when you look at these analyst downgrades, it may not always be just because we think the outlook for this business is cloudy. Home Depot has a lot of different ways that they can be successful in almost any type of environment. But I think there's also to keep in mind, like relatively speaking to what's happening with Lowe's and what Lowe's performance has done, I think that plays into this discussion a little bit.
All right, guys, now let's pivot to some trades we did yesterday. One's going to be real easy. The NVIDIA trade, is just one that's going to go to full value. We have to make a new trading decision on NVIDIA where we want to get in. But Nordstrom's a little trickier, and it's something I want to look at, which is this. Nordstrom, we have on just a short put vertical. okay, that we basically said, if you look at a chart of Nordstrom, Scott, we'll throw this up here. Look at the 54 level in Nordstrom and how busy it is right there. So we basically sold the 55-51 put vertical for around 80 cents. So targeting about 54.20 is our break even, right around this level, right? Now, we've gotten a move through there down to 51, but we're short the 55 puts, long the 51 puts. That's going to be a loser today. But here's what I think we should do. I think Nordstrom anywhere around the $50, 52, 53, this range right here that's got so much activity is something we should use as entry points, right? That's the perfect way. So if you have this trade on, Scott, and this is where we're going to get into the minutia here, can't we just turn this into long stock via selling out the long put, right?
Absolutely, you can do that. Now, I'm never a believer of turning bad into good, trying to make a big correction for a trade that went against you. But here, there's some really good technical and what I believe fundamental reason to whether it's adjusting this position or taking a new position here based on that bias. That's what I would do.
And right now, Sean Cruz, it's the classic story of we're in between our strikes. So we're going to have to do something regardless anyway today. If it stays higher than 51, lower than 55, we've got a between the strikes, so we're going to have to do something. What a lot of people like to do here, and this is one of the things you do with cash secured puts or put verticals, you take the stock at this level, right? We did this on purpose. We sold this spread targeting the 55 strike for about 80 cents, targeting 54.20 as a range we can get in. Well, we're going to get this lower than that, right? So that's what gives us some great opportunity here. Sean, is it fundamentally sound to turn a stock like this into a covered call strategy, right? Flip it from one side to the other. Go ahead.
Yeah, I think if that was was that your kind of your theory or your thesis going into this trade?
Absolutely,
I'm going to bring in some premium, and I'm more than comfortable getting the stock put to me. If that was your theory going in, then this is actually playing out according to what your plan was. So it's something, unless you saw something come out in that meantime that really changed your fundamental opinion on the name, then you should carry on with the plan as usual. If, on the other hand, you sold that spread expecting that to be maybe some sort of a support level or not really breaking below that, then maybe you need to think about just getting out of that position, cutting your losses and moving on to the next trade. But there is an accumulation strategy of selling those puts. Worst case, you bring in the premium. Otherwise, you take the stock and then you start trading it on the long side, doing buy rights. Maybe you go in and look at some sort of a collaring strategy, whatever that may be.
Scott Bauer, I don't know if the P&L was my game plan. However, Plan B says at this level, I'm going to stay with some type of long position in JW Nordstrom.
I agree, and I'm seeing a lot of people have the similar or the same, let's not call it a problem, but the same issue this morning with NVIDIA also.
Right.
So, yes, I do like turning this into a longer-term long position just based on the technicals here.
Right.
So, then the key is, all right, what do we do? What is the most efficient way to manage this trade?
Right.
And then going forward, optimizing any sort of trade moving forward.
Because here's what you have to worry about. If you turn this into a covered call strategy now, you're not hedged all the way, because you're short puts against short stock. So there's a problem there, right? You're not long the underlying. You'd be naked short calls, basically.
Yes.
So you have to wait till Monday to actually turn it into a covered call strategy. That's one of the risk factors that we have to do. Think about it. If we just sold out the long put today and sold calls against it, well, if the stock rallies $20, you're naked short calls. So there's until Monday, you can't really do that. You can't turn this position into a covered call strategy. So that's one thing for everyone to pay attention to. You can sell out the long put today, but you can't hedge it until Monday morning when this turns into long underlying. Or you could just unwind it and buy the stock. Go ahead, Sean.
Kevin, what do you think about, maybe you don't go out there and just necessarily sell naked calls on that? What do you think about selling a call spread?
Well,
so if you do get that massive $20 rally, you're at least hedged in that.
Right,
regard.
exactly. If you wanted to do that today, you absolutely could sell a call spread. That would cover the risk, because then the risk would only be the width of the strikes. So if you want, but that would generate more commissions. If you just waited till, if you sold out the long puts today, waited till Monday, and then sold calls first thing in the morning Monday, that would take care of maybe some less commissions. But depending on how aggressive you want to be, that's that's another way to attack this for sure.
So can we bring up the option chart here? What are our long puts trading right now? Probably not much, right? Because
we're in between the strikes.
3 hours, 4 hours left to go here. It expires today. So yeah,
so we are
down
short
to a nickel, right?
Right. We're short the. Oh wait, hold on.
Short 55, long to 51.
Sorry, wrong
right?
one. Yeah. Nordstrom. There
we go.
Yeah. So one is trading 385, one's trading 43 cents.
Okay, so if you sold out the longs today and were willing to accept the stock,
right,
what you've done is just reduced your cost basis even more so by another 43 cents or so. So our original our original point for getting in the stock on this spread here would have been 54.20.
Right.
Okay. If we just sell out the long right now and are willing to accept the stock, you've now reduced that entry point to 53.75ish,
right,
or right in that
something below 54.
Exactly. So that's an idea as well.
That's the way I think you attack this, because then the other thing you could do is obviously sell this put or buy in this put vertical and buy the stock. If you wanted to be, that's the other one. But again, that's generating more commissions that I don't necessarily want to do if I don't have to. I can just let gravity get me long the stock just via selling out of this long call, or the long put. I'm sorry, the 51 put. We'll sell it for mid-market about 44 cents, and now that is out, and now we are naked long a deep in the money put for the rest of the day. And then Monday morning, we can turn that into a covered call strategy. That's kind of the way I look at that.
Agreed. And again, you just reduced your effective entry point on your long stock, assuming that the stock doesn't rally back today and you get assigned on your short put.
All right, guys, it's Fang Plus Friday. We're going to take the next few minutes and we're going to go through every Fang stock today based on where they are now, how you would attack this. What strategy would you use, what you're looking at, okay? Let's start with the first one, which is the F in Fang, which is Facebook. Now, Facebook, more headline news today. Now there's, this is a company, more than any company I know, and we say this a lot on the show, has got to stay off the headlines. They've got to find a way to get out of the news that's every day. It's something now about Facebook. They had a lot of people being interviewed on TV this morning talking about Facebook and all their problems. Scott, this is still a company that makes a lot of money. It's got big earnings. It's got an extremely low PE, now down to 21. Unless there's something fundamentally wrong with this company, right? It still has 100 million people looking at this. It's massive numbers. So how do we attack something like Facebook? First, let's start there. Sean, I'll go to Sean Cruz first and then back to Scott. How would you attack Facebook? How would you personally trade Facebook?
So right now at Facebook, just because that name's so volatile, and let's say you think this selling's a little bit overdone, you don't necessarily want to come in and say this is where it's going to turn around from. So I would definitely look at some premium strategies where you're bringing in some of this premium on this elevated volatility. And the FANG names across the board generally have somewhat higher premiums than maybe some of those other more stable sectors. So you can go out of the money a little bit, sell some put spreads, for instance, and bring in that premium. And you can even afford maybe a little bit more selling pressure in Facebook, and you're still got a little bit of wiggle room before you start threatening that short strike. That would be one way that I would look at maybe getting some upside exposure if I think this is where Facebook starts to catch a little bit of a bid and gets a base that it could potentially rally off
IB
of.
percentile 57, Scott, so better than half. You're getting some nice premiums, but you get nice premiums a lot in Facebook, especially lately.
Yeah, I mean, this is so Tesla-esque, like you said, Kevin, where it has to get out of its own way.
Right.
It has to stay out of the headlines. I agree with Sean. I think you want to sell some premium here. Now, I'd be looking at one of two things. okay? Either selling a downside put spread, and then if we get a rally, probably selling a call spread against that to manufacture my iron condor where I've collected premium on both ends.
Legging it.
Legging
selling
it.
the put spread here, waiting for a rally.
Exactly.
Nice.
Or you can do a stock replacement.
Right.
Okay. You can go in and buy a deeper in the money call out to maybe March. You know, a 70 delta-ish call, maybe around the 125 level, maybe 130 level, and sell an upside call, which still is going to have a lot of premium here. So effectively, you're putting on a synthetic put position.
Right.
You're still collecting premium. So I think you can attack it one of two ways, and I think that's the proper way to do this.
I think both of those work. One, you play a little more of, in Sean's case, you play a little more of the probabilities, but all you make on that position is the premium that you took in.
Right.
Scott Bauer's is a little longer of a play, more in the diagonal calendar spread family. That's more of a directional play as well, but you actually do better as the stock moves.
Sure.
Right? So both of those work. Both of those collect theta every day, not pay it. That's crucial here. A little different idea, though. One owns more premium than it's short. The other one is short more premium than it owns. I like, those are the two that I would pick out absolutely. I confirm both that as a strategy. Now, let's keep moving. And we'll go to the next, the first A in the FANG, which is Apple. Now, Apple is something that you can make the case today. It's kind of helped bring this market back. Having a really strong day. Now it's off its highs, but it was, it's up close to $2 on the day. It traded as high as almost $95 today, Scott. So $195, sorry. So Apple, another one, very similar to what we're talking about. Cruiser, I'll let you go first. Live from Omaha, Nebraska. How would you attack Apple? Now this is one who's having a nice day here.
And this is, so Apple's another one, and maybe for some viewers out there, because I know Apple's also very popular holding to hold long on the equity side. You can look at as some sort of a way to get some maybe protection on the downside if Apple does maybe come back into correlation with what we're seeing the broader tech sell-off. So you can look at going out there, and I would just say, like, pick the 180 put. You can sell that put, go down to 170, buy two of those puts. So now you're bringing in some premium, because you can do that for a net credit. If you look out, I'm looking at December options. So you bring in that, say the 180, so you're going to bring, we'll call it $2.55 in premium, and then you buy two of those 170 puts that's going to cost you about $2.10. So you're bringing in about 45 cents of premium on that. But if Apple really does rejoin some of the bearish activity with the rest of the tech names, you're kind of protected on the downside once you get down into that 170 level, but you're still bringing in some premium alongside of that. And that's something I've been looking at for some of these names that are widely held, and you're starting to see a lot of volatility. There's one way you can maybe hedge some of that downside risk and still bring in premium.
Kind of a 1x2 for a credit, huh?
Yep.
Hold on, let's get some of our, there we go. That's the right graph or something like that. And so what that does, if Apple were to go on the upside, all you do is make your credit, right? If Apple goes to the short strike is where this is exposed, but any big down move in Apple through the one, all the way down to the 160 strike is where this starts to be profitable. It's curvature. Right? You're buying curvature, you're playing for the big move, but not necessarily a big move on the upside, Scott.
Right. I would look at this almost very similar to Facebook. Right. And let's take a look. Where's IV rank now in Apple? Okay, with earnings behind us and nothing in the imminent future here.
61, just slightly above where Facebook was.
Slightly above, but still on the what I call the sell premium side. I would look to do a very similar type of setup of either selling a downside put spread right now and then trying to collect some premium on the upside if it rallies, or a stock replacement here. But still, underlying theme, collect premium.
Exactly. Collect premium and collect theta on a daily basis. All right, guys, let's take a quick break. We're through 2 of our 5. We're coming up next. Ken Rose is going to join us live from Salt Lake City, Utah for our face-off segment. He's going to talk about Ella Brands, perfect for me, Victoria's Secret. Stay right here on the TD Ameritrade Network. Fast Market. We'll be right back. Welcome back to Fast Market, everybody. I'm Kevin Hinks, joined again by Scott Bauer, CEO of Prosper Trading Academy. Let's do a quick market update. They're drifting a little bit.
They're drifting.
You know, this is one of those days, and you've been through a million of them in your career. This real trading day hasn't shown its hand yet.
No,
right?
not at all.
It's going to be that last hour. That's like you take a break midday and get ready for that last hour, because that's when this market's going to see, are we running out of gas on the downside, and who's starting to take over this market?
And to throw a little extra piece of kindling wood into the fire here,
Nice.
in addition to all of the risk headlines that we've discussed, you also have a pretty big holiday week next week.
Yes.
You are going to have a lot of traders.
Excellent point.
A lot of traders not even be in next
Right.
week at all. You're going to start to see volumes thin out a little bit, and we may even see just a little bit more volatility than we have because of
However, what I always like to say is, if you're having a really good year, yeah, you take this week off. But if you're not having a great year, which the last month of trading may have dinged a couple people's
Yep.
years, that you might have more people watching than normal.
That's very true.
These markets are a little choppy.
I always loved trading the holiday weeks
Oh, me
because
too.
it really gave a lot of opportunity.
I'll tell you what I used to do in the GE pit. I'd walk in and go, hey, who's coming in next week? If a lot of people were coming in, I'd take off. If no one was coming in, I'd go in to trade.
That's
I used to
right.
like to do the fewer people, the better.
Absolutely, 100%.
All right, let's get into some more markets now. We've got 3 more FANG names to go. First one, Amazon. Now, this is a stock. If you look at the chart on Amazon, it looks like a lot of charts in this market right now, Scott, except here's one thing. These numbers are a lot bigger. You're coming from the 2,050 level down to 1,600, 1,500 level. Now you're sitting around 1,585. These are big numbers we're talking about here.
And I hate to be redundant, but you look at this and say, why was the stock 2,000?
Right.
And have the fundamentals changed? Has earning growth prospects changed? Are they not making as much money? Are revenues not the same? And from everything that I've seen, everything that I've read, I haven't really seen much of a change in their model here. You have the holiday season coming up. I don't know. I mean, you never want to catch that falling knife. This is one, though, that I would lean something towards the long side.
Here's what a key thing to look at when you're trading something like Amazon, and that is, look at how wide the bid ask is on the stock, right? It's right there. It was 74 cents. The spread between the bid and the ask on the underlying. So therefore, you've got to be ready for a dollar move in Amazon is nothing.
Nothing.
So everyone's got to understand, when you talk about ebb and flow, I'm going to put up something, a 1 day, 1 minute chart. Follow me to the screen, Robin. Take a look at this. Look at the ebb and flow of this stock. This is why, if you're going to trade something like Amazon, the normal parameters, if a stock's trading an option spread's trading, like say $1.50, right? Maybe you put in a 160 offer. No, that's nothing.
Right.
That's nothing. You want to trade this, maybe if it's trading in dollar ticks, you may want to put your stuff much wider, right? And not get just, I guess I call it being a bug on the windshield of this stock moving. And that's what you don't want to be, right?
No doubt about it. And you can take advantage of these wide markets as well by exactly what you were just saying, Kevin, widening out your bid or your offer on your parameters, because the likelihood is that you will get filled because this thing is just gyrating back and forth so much.
I mean, think about it. A spread could move 20 cents on one tick in the stock.
Sure.
Right? Easily. And it could go from being mid-market to bid.
Easily.
And things like that. So this is just everything you think about trading options, widen out. It's not that you can't do it. Matter of fact, it's probably a great little trader. I don't trade much of Amazon, to be honest with you. But you just got to widen everything out, right? And just play a much bigger game here.
No doubt about it. Your parameters have to be wider. Your stop losses, if you have one in there, probably have to be a little bit wider. And you still keep it close to the vest here. But again, like you said, the numbers are a lot greater. You have to take that into consideration.
IV percentile 77.
Yep.
Total options trading today, Scott, so far, 117,000. Where does that, for a stock like Amazon, is that considered a lot? Is that considered, look at the put-call ratio, right? We're in a normal range of where it would be.
That's not bad. I mean, it's really, really liquid. And it's not just liquid for this week or next week. Most series that you'll look at, weeklies even going out to December, January, there's liquidity there. Now, the markets may be a little bit wider, but there's a lot of liquidity. So if there's a strategy that someone likes within a time frame that they like, you can get it done here.
Right. And what I like, options that trade between the markets, right? 56% of the calls, 65% of the puts. That tells you don't hit bids, don't take offers. Price discovery mid-market.
That is something that I think gets really overlooked by a lot of retail traders. And this is so important here, guys. 60% of the total, if you look here, 70,000 contracts of the 118,000 that have traded today have traded somewhere mid-market, much to Kevin's point of expand your parameters here and let the order come to you.
Price discovery is a job. Almost. Don't be afraid to work your orders. And on that same theme, let's go to Netflix, the next one. Another stock was $400 and some dollars. Now it's in the 280s. Another stock, Scott, that is, it was $423. Now it's $280. All these names, they're all in similar places, right? Where people are worried about how much they're moving. But look at, Scott, again, 50% of the options traded are traded mid-market. The markets are going to be wide. You know that. They're going to be wider than the normal names. But again, IV percentile 74, so high vols, wider markets, but still 80,000 options trading and half of them trading mid-market.
Is it interesting to you? Because it is to me, going back to what we looked at in the first segment with Apple and Facebook, where their IV percentiles were only about 55, 60%.
Right around 57 and 61, I noticed.
Right, that Amazon and Netflix are up in the 70s. What's going on there? Does that mean that
Apple's recovered a little?
Apple's recovered. That's absolutely true.
Facebook hasn't.
Right. So does that tell you that maybe the public, the retail, is a little bit more skittish on a stock like Amazon or a stock like Netflix? Right. So does that mean you're bearish? Does that mean you're bullish? It means opportunity.
No, it's your opinion is the genesis of the trade you put on. Once you decide on that opinion, now you got to dig into this platform and get all the fundamentals out. This should drive what strategy you put on, where you do, how wide you put your spreads. All of these things are key because all of them put together comes out to a pretty good options trading strategy.
No question about it. And each little piece of those dynamics, it's like a jigsaw puzzle. They all fit together to really help you decide what may be the best strategy.
And now the final one, which is Alphabet Google, right? And this is another one. If we go to the chart, up to 1291, now 1057. Big moves off their highs, indicative of all these FANG stocks. So the reason I wanted to do the show like this today is to show people, what are you getting into? What is it that are you looking for entry points? Are you looking to trade these? How should people be looking at all these FANG names? If you lump them all into one big bundle, how should they be looking at them?
Well, the bottom line is don't try and go out there and be a hero.
Right.
Meaning, don't just say you're decidedly bullish, decidedly bearish, and take a risky position. Risky meaning not risk defined. You can always cap your risk, and especially in an environment like this, it's imperative that a trader does so. Whether it's by a put spread, a call spread, whatever it is, you have to be able to have a risk-defined position. I personally don't like Google or Netflix as much as I do Amazon. On the upside here, I'd be looking to sell premium in both of these, probably with a little bit of a bearish bias.
And again, going back to today's option statistics, 66 on the IV, so about 2/3 of the way up. But look at this, Scott. 68% of the options trading mid-market. But look at this. Only 9,500 options traded today versus over 100,000 in some of these names. Not a real big trader in Google.
No, it is not. But yet
Google Alphabet.
Yeah, Google Alphabet.
We're going to always get controlled on. Go ahead.
Maybe the most important lesson that the viewers can take out of this today is let the market come to you. You don't have to go out there and buy those offers and sell those bids. We are market takers doing what we're doing right now. We're not market makers like you and I used to be on the trading floor where the order flow came to us and hit our bids and took our offers. Play the market. Play the middle of the market here. Feel it out, and like you said, price discovery.
Scott Bauer, CEO of Prosper Trading. Such a good lesson on how to look at these names that are really the headline makers in this market. We go through all these names, we stick to the fundamentals, and you make the trading decision how you want to do it, but start with good fundamentals. That does it for Fast Market today. Tune in Monday at 10 a.m. Central right here on the TD Ameritrade Network. Have a great day, everyone.